Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Spill. COVID made things difficult for the sporting world. Although many venues remained closed, sports continued on. And at some point soon, life will return to normal, which is precisely why Manchester United is an interesting stock. The fabled soccer/football team from England boasts an active global fan base. Currently, shares trade just above $14, some of the lowest levels in the last decade. However, the financials don't look that great at first glance. And as far as interest goes, it ranks 24th out of the 35 leisure ticker searches by retail investors last month. But could Manchester United be staged for a turnaround? Manchester United is an English Premier League team from Manchester. And as one of the most successful clubs in European football, they've built a global fan base. In fact, most of their fans reside outside of the UK. Their revenue is divided into three segments: matchday, commercial, and broadcasting, and it's the third segment that has seen the most growth in recent years. But the company's performance over the last decade has been quite lackluster. However, on an operating basis, the company generates cash rather consistently. But when you take players into account, free cash flow doesn't look as hot, but it is still positive most years. Additionally, the company pays a 1.23% dividend yield, which is decent. And looking at valuations, since the club hasn't turned a profit lately, we need to look to alternative valuation methods. There is one metric here that catches our eye: price to sales. While it's higher than the sector median, it's much lower than the 5-year average on both a trailing and forward basis. That's important because the trailing doesn't capture the company returning to full revenues quite yet, while the forward measure does. This says investors still value the company below its historical performance, even when sales return to normal. In our opinion, we rank this stock at 9 out of 10, and you might be surprised we rank this as high as we did, especially with the club struggling on the pitch. But when we consider the current share price in historical context and outlook, we see a lot of upside. No, we don't necessarily believe the company will start hitting amazing earnings anytime soon to give it a nice price-to-earnings ratio. However, the company isn't going anywhere. So, considering the stock has traded as low as $12 back in 2013 and as high as $27.70 in 2018, $14 to $15 a share has a nice risk-reward profile. Click and subscribe to the Spill newsletter to get the full breakdown.